am joined by Mark Jenkins, who oversees the credit business at Carlyle, and credit has definitely been the name of the game here at Milken. It's where the roots are of this conference, after all, and it's also the heartbeat of the American economy in a lot of ways. How do you feel about this moment in time? Obviously, tariffs have been causing a lot of anxiety. Do you find that to be overwhelming for the investment community, or do you find it to be something that they're actually finding a lot of opportunity in?
Well, I think if you step back, I think the tariffs right now are just temporary noise. I think the foundation of what we've been looking at, the trends that have been changing, really started post-COVID, which were, reshoring of critical supply chains, redesigning your supply chains, if you will, in the face of what we saw during COVID. And then also realigning some of our global alliances as it relates to trade. And I think the fourth thing that's happened that people aren't taking into account right now is the advent of AI that happened. So all those trends were happening. Tariffs are really just accelerating some of those trends that we've already been experiencing for the past 5 years.
So what does that mean in terms of how you map out your year and the way you're planning on deploying capital? Is it a pause kind of moment like so many CEOs are talking about?
Well, I think right now the moment in time is maybe call it the 3 Ps. People are pausing, right? People are preparing because we think there's opportunity, and then we're going to prosecute in opportunities that we think that make sense in the context of a very wide range of outcomes that tariffs are causing. That uncertainty that everybody's talking about creates a very wide outcome, bandwidth of outcomes, if you will.
So what does this mean for the cost of financing moving forward? We've been talking to a lot of people about the 10-year, Scott Bessen's favorite kind of gauge here of how the markets are looking at the plans moving forward from the administration. 435 on the 10-year. Higher or lower for the direction of travel?
Yeah, I'm not good at predicting where treasuries are going to go. What I would say is I think we're surprised at how tight credit has remained. I mean, we're basically back to April 2nd kind of levels, if you will. And I think that has to do with a couple things. One is what's happened in the past 5 years in terms of corporates getting themselves kind of back in shape from a balance sheet perspective. If you look at where leverage is and where interest rate coverage, it looks pretty good, close to pre-pandemic levels. I think secondly, you haven't seen so far in the numbers a sharp drop-off with respect to economic growth, and I think that's probably buoying things a little bit. But we would expect, if there's a slowdown, that levels are going to change over time.
Are there places of the economy that you're avoiding right now, given the potential pressure of tariffs?
Yeah, I think it's very difficult in the retail space. I think it's very difficult if you're a distributor that's reliant on imports specifically from China. I mean, autos and auto suppliers right now, the uncertainty around that, those are kind of areas where historically, we haven't really played anyways, but I would say would avoid right now.
So what does this look like for private markets? A lot of people have a lot of questions about what marks look like under the surface with the whipsawing of public markets. We talk about this a lot.
Yeah.
I know you have some skepticisms on some of the numbers that we're seeing out there in terms of how bad things might get.
Well, I think that, when we think about private capital and what function that performs, if you will, in the overall economy, private capital has, as you know, grown over time, over the past decade, if you will. And that's a good thing for the ecosystem because you have more sources of capital. All of the changes that we're talking about that are occurring in the global economy require more capital. And in fact, will play to the strength of private capital. Now, the cost of that, in theory, should go up because there's more demand. But I would say private credit, private capital, private equity is well placed to take advantage of the changes we're seeing. I think the underlying marks that you're getting to, I think all of us, by and large, have a lot of oversight with respect to what we have to publish because a lot of us have public vehicles out there that have daily marks out there. So, I know people talk about that as being a big issue. I'm just not 100% sure that's completely correct.
So do you think that there could be bigger issues ahead? One thing people talk about a lot, and you've seen it happen over the course of the last couple of years, private equity firms, they haven't been able to exit investments. There hasn't been a whole lot of M&A either.
Yeah.
These are all places that tend to be the lifeblood fuel for the private credit markets, if you will.
Yeah, what's happened really in the past, I'd say 5 to 7 years, is what I would call private credit. The definition of that has expanded greatly, right? So you've seen a huge expansion into asset-backed finance, investment-grade private credit, which really doesn't rely on M&A activity. I think, what you're talking about is I would say today is a relatively narrow, slice of what overall I think of as private credit. Some people define that as 23 trillion plus. And in that kind of venue, direct lending, in sponsor activity is a small sliver of that. So I think there's a lot of activity out there today for investors.
So from where you sit, where is it exactly that you want to be operating? Are you pushing more and more away from that traditional direct lending type into more asset-based? You've obviously at Carlyle done some massive deals in the asset-backed space.
Yeah, I would say, look, we're always going to be focused on that element. I mean, that's cornerstone to almost anybody's private credit business. But I would say the non-sponsor business has been very attractive for us in terms of our ability to pivot there. And I would say asset-backed finance, for us and others, is an area that is growing, and it's growing quite dramatically, if you will, in terms of access to that marketplace.
Mark, talk to me a little bit more about the dynamics you're seeing through the course of the year. We talked a little bit about potential capital deployment, but really what I want to know is what types of opportunities are you looking for, given all the tumult under the surface?
Yeah. Right now, until that M&A activity picks up on the sponsor side, that's just not happening, right? I mean, ideally, we're all expecting that'll happen. I'm not going to predict when that's going to happen. We still see a decent amount of activity, especially in Europe, on the non-sponsor side, where the banks have retrenched, if you will, for what we consider to be relatively large, well-capitalized, family-owned, founder-owned businesses that aren't sponsor-driven, and we've been working a lot there. Direct lending in Europe has actually been more attractive than in the U.S., and asset-backed has continued to be an interesting area as that market is just really opening up, I think, on the private side.
It's interesting. I'm glad you mentioned Europe because it's been a big topic here. Investing not just in the United States, but outside of the United States. The promise of Europe has come up a lot. How do you feel about it?
Well, I think there's two ways to look at that, from the equity side or the credit side. I think I won't speak to the equity side. I certainly would say from the credit side that it presents a lot of really interesting opportunities because it's not one unified market. You have multiple markets there with multiple participants on the finance side, and that makes it so attractive because it's much more fragmented. And I think our ability to pivot into the companies that have global exposure that are based in Europe is really attractive for us.
Now, Mark, I want you to make a comment of the market overall. Frankly, a lot of people have not been through a severe downturn, at least as bad as 2008. There have been, of course, the COVID downturn as well as the Silicon Valley Bank crisis, but a lot of people have not really managed through a full business cycle in this industry. You've managed through several.
So you're saying I'm old, I think is what you're saying.
No, I just think in private credit in particular, what are the lessons to be learned here for people who are much newer and frankly considered tourists to the industry? Yeah,
I would say so. You're right. I started as a credit analyst 35 years ago and have been through various cycles that weren't, talk about pre-GFC where we didn't have massive monetary stimulus to keep rates at zero. I mean, we did go through normal cycles. And I think what's happened over this period of time is in larger organizations where you have the capabilities not only to, make portfolio decisions, make credit decisions, but also when you have to go through a downturn and deal with running a company, taking ownership, and realizing on your collateral, those are different skills that haven't necessarily been tested over the past 14 years. And I think in larger organizations, when you can rely on, your private equity business that has operating partners and we own companies, I think that'll benefit investors going forward if you're working with large asset managers. And not just us, there's many of us out there that
Right,
do
this
that.
is to say that if things get really bad out there, you might have to take control of the company.
Correct.
And then all of a sudden you're an asset owner instead of a lender.
Correct. And at the end of the day, we're going to create value by taking charge of that and realizing on our collateral in a more productive way than just selling at a distressed value.